In the minds of most people, an options is the grail. Where if you guess the trend movement, then this tool can bring you tens or hundreds of percent relative to the funds invested in this options in a fairly short time. But at the same time, if you are wrong, then your losses are limited to the premiums that you pay to the seller for the purchase of this options. And therefore it seems that the options is a miracle that gives you the opportunity to earn a lot while the risks are limited. This is partly true. And let's move on to considering the main advantages options trading. And I want to say again, you should understand that on options, as on stocks or futures, you can lose your deposits. It's just going to happen a little differently and take longer. And you have to remember that there are always and everywhere risks. The first and main advantage of options is that it does not have stop losses. That is, when you buy, for example, a stock and the stock is worth $100 and this stock has fallen to $50, for example, then your losses in this case are $50. At the same time, if this stock moves up and reaches $200, then your profit is $100. Everything will be a little different on options. If you buy one option on this stock, for example, at a price of $10, then your maximum loss is $10. This is the premium you pay to the option seller. And no matter how much the price of this stock drops to $50 or to $5, your loss during the duration of the option will be only $10 at the time of its expiration. But at the same time, if the stock falls, for example, to $50 and then has time to grow until the expiration of your option, then you will also make a profit on this. And if your stock continues to grow to $200, then if you buy an option for $10, then you will earn the same $100 as if they bought one share. The second advantage is that in options you can manage your risks. That is, even if the underlying asset begins to move down and accordingly your option begins to lose in price in any unpleasant situation, you always have options how not only to minimize your losses, but also to make money on this failed potential upward movement. You can really manage your risks during the life of the option. Speaking of stocks, if you bought for $100 and it dropped to $50, then you have only two options how to minimize your losses. Either close the position or wait and hope that the stock will rise in price. The third advantage options in the fact that there is no hunt for stop loss. For example, let's take the situation on the index SP. Suppose there is level from above. It seems to you from a fundamental or technical point of view that SP will start to fall from this level and you take a short position. And suddenly there is a sharp upward movement, that is, it breaks the stop loss. And this situation is starting to be unpleasant for both sides. On the one hand, you immediately lost money, on the other hand, you start to be demoralized. When you have triggered a stop loss, it becomes quite difficult to take a short position here for the second time from a psychological point of view. There is no such situation on options. If you bought a put option in this situation, that is, you put it down, your loss will be limited to a certain amount, no matter how much the price of the underlying asset will go up. You will be interested only in the fact that at the time of expiration, the price will return back below the purchase level of the put option, and then you will make a profit on it. Let's summarize. First, you will not lose more than the value of the option. Secondly, you have the opportunity to manage your position during the life of your option. And third, you will never encounter such a concept as hunting for a stop loss. The second point. The option price suggests probability. When a trader looks at the chart, he starts making decisions at any point. He always thinks which position to take, long or short. And the trader begins to compare several at once factors. He looks at technical analysis, he looks at fundamental analysis, he looks at the news background, and he looks at how things are in politics. And he is trying to predict some other alternative scenarios that may affect the further movement of quotations. Accordingly, from this decides which side he will take, the side of the bull or the side of the bears, and most importantly decides what part of his deposit he is willing to sacrifice. And in options, all these probabilities and all these mathematical expectations are taken into account initially. If the underlying asset is, for example, $1,000, and there is a call option with a strike, for example, 1,010, and a put option with a strike 990, and you see that at this moment the call option is worth $700, and the put option is worth $500, then looking at the value of these options, you can conclude that the price is likely to start moving up, because in probability the market expects just such a movement. That is why in this case, the call option is more expensive than the put option. The third point. Multiple parameters evaluations. This paragraph perhaps reveals the basic essence of the option. The option consists of several components, and you may have situations when you guess with the direction, but do not guess with time or with volatility and thus suffer losses. That is, say, at this point you buy a call option in the hope of the growth of the underlying asset and, as a consequence, the growth in the value of your options, but there is a situation that the underlying asset starts to be flat. As a result, then it starts to grow, and it would seem that you guessed globally here in the direction, but the expiration date of the option was here, and thus your money burned there. There are other options when, for example, you are not guessing with the direction but guessing with volatility and with time. And if a situation happens when you simultaneously guess the direction, time, and volatility, then you can tenfold your profit. This is especially true for cheap options with a close expiration date. For example, you are trading SPY, the chart has hit the resistance line, and you think that most likely a breakdown will take place at this point. There are 2, 3 or 1 days left before the expiration of the option, and you buy yourself a more or less distant strike with a fairly cheap price. And if a breakdown takes place, since the option is cheap and the movement will turn out to be very impulsive and volatile in the shortest possible time, then on such movements you can take tens and hundreds of % relative to the invested money in this option. Then the risk-to-profit ratio will be simply colossal. Also, you can calculate your risk. It is very easy to calculate the risks on the underlying assets, I mean on futures or stocks. For example, if you bought one share for $100 and it has fallen to $80, then your loss will be 20, and you can either close your position or average your position, and that's it. Everything will be much more interesting for options. If you bought a call option, then when the price of the underlying asset changes, you will be able to additionally apply some solutions and additionally control your risks and calculate them in advance, understanding one or another alternative a variant of the development of events. Well, now let's move on to a more detailed study of options. Let's talk about what they have inside and how to use it. To begin with, let's analyze a few terms. What is an option? What is a put and call option? What is a strike, and what is the underlying asset? An option is the right to buy or sell an asset at a certain strike price in the future. The key word is right, not obligation, as if you were trading futures, for example. The underlying asset is the instrument against which the option is traded. That is, the underlying asset is either futures or stocks. A call option is the equivalent of long positions. Buying a call option, you bet on the market increase, and, accordingly, a put option is the equivalent of short positions. By buying a put option, you assume that we will have a downward movement. In simple words, an option can be compared to car insurance. And that is why you have probably often heard such expressions that traders or investors buying an underlying asset, for example some stocks, prefer to hedge their risks through the purchase of put options. Suppose there is some underlying asset with a price of $1,000. You decide to buy this underlying asset. But you also want to hedge. You take your risks and buy a put option at a price of $50. That is, you put it down. There are the following scenarios. If the price increases higher for the underlying asset, say by $100, that is, up to the price $1,100. You earn $100 on this move, but you lose $50 on a burnt-out put option, and your net profit is $50. But an alternative scenario may occur when the chart goes down, so you will lose on the value of the underlying asset, but you will start earning on the purchased put option. Since options are insurance in a sense, their price is formed according to the same principles as any other insurance. I mean car insurance for an adult male with 30 years of driving experience that has never been in a car accident. It will be much cheaper than insurance for an 18-year-old girl who got a driver's license 6 months ago, and I've been in a car accident twice already. For her, the probability of getting into an accident is about 50%. The same thing happens with options. If there is some underlying asset with a conditional price of $100, then the most expensive options will be those whose strikes are in close proximity to the price of the underlying asset. This is because the probability of the price moving towards one of these call or put options is about 50%. This can happen against the background of banal stock noise and have nothing to do with either fundamental or technical analysis. Options whose strikes are in close proximity to the price of the underlying asset are called at the money. The same principle applies to those options whose strikes are above the current price of the underlying asset, but with different expiration dates. I mean, if there is an option with a strike, for example 110, but the expiration date of which is scheduled for the day after tomorrow, then this option will cost less than an option with the same construction 110, but the expiration date of which will be in a month. Because the probability that over the next 1 or 2 days the price will go higher by 10, the percentage is significantly less than the probability that the price will go up by 10% over the next month. The yield chart for the purchased call option will look like this. In this example, we use RTS Index Futures as the underlying asset. Its price is 136,680. You can see the RTS Futures chart now. It is really trading near these zones. We buy one call option with a strike of 137,500 at a price of 2,000. Thus, if the underlying asset such as futures on the RTS index continues to grow, it will reach, for example, the level of 146,000, approximately in this zone, then the stake option will rise in price, and its price will already be 8,000. If futures on the RTS index will continue to grow further and, for example, if it reaches 162,000, then the call option will cost 23,000. At the same time, if the underlying asset starts to fall, then our losses will still be limited to 2,000. I would like to draw your attention to the fact that you will receive losses if the underlying asset starts to fall not immediately, but gradually. That is, if the price of the underlying asset changes by 500 or 1,000 points, your option will still be worth something. Simply it will cost, for example, not 2,000 but 1,000. You also need to understand that when you buy a call option for 2,000, this does not mean that the figure minus 2,000 will immediately appear on your balance. This means that you will simply see the changing value of your option. Then today and now when you bought it, it costs 2,000. If the price went against you, it may cost 1,500 and so on, but if it grows, you will also see how it starts to cost 3,000 or 5,000, and you always have the opportunity to sell this option at any time when you want to lock in your profit. The yield chart for put options will be to look like a mirror, relative to the yield for call options. Since the purchase of put options is a fall bet, then you will earn if the base price falls. And just like in call options, your losses will be limited by the value of the options. The most important parameter for options is delta. The delta shows how the option price changes relative to the price of the underlying asset. We already know that the most expensive options will be those whose strikes are in close proximity to the price of the underlying asset. Because that the probability that the price will go up or down relative to the current value is about 50%. For such options, the delta will be 0.5 or 50%. In other words, if we buy a call option from, for example, and it starts to grow in price, then the delta starts to increase. And at a certain point, the delta begins to make up a unit, and the value of the option begins to behave the same way as the value of the underlying asset behaves. On the graph it will look like this. This is a chart with purchased call options with the nearest strike. Here you can see that it starts to add in price gradually. We do not see instant exponential growth. This is delta. For this option, the delta will look approximately as follows. Here goes in the black line is the price of the underlying asset. We bought an option with the nearest strike of 137,500 approximately in this zone, and you can see that the delta is 0.5 or 50%. And when the price starts to rise and approaches the level of 139,000, the delta is 0.61 and so on. And one day when the underlying asset starts to cost more than 140,000, the delta becomes equal to 1. The same the most happens when the price does not go in our direction. We bought a call option after that, the value of the underlying asset will decrease and the delta will also gradually decrease until it has fallen to 0. And I came to the zone below which you will not lose. On the delta, you can do well to earn. We know that if the most expensive options are those whose strikes are as close as possible to the current price of the underlying asset, then the cheapest options will be those whose strikes are far from the current price of the underlying asset. And these options have the smallest delta, because the probability that the price there will come quite low. However, as the price increases, this option is revalued. That is, its cost increases because the delta begins to grow. Because the closer we are to the strike price, the higher the probability. On the graph it will look like this. At the current price of the underlying asset 136,180, we can buy one call option with a distant strike of 147,500. This option will be 90 conventional units. Its delta will be 0.04, and as the price of the underlying asset moves in our direction, when it reaches at least 138,800, the delta will change to 0.10. In other words, it will grow by more than 100%. Thus, already at this point you can sell your option while recording a profit. The yield chart of this option shows that as the price moves in our direction, even at the level of 138 or 139,000, our option will already rise in price 2 or 3 times. And if the further growth of the underlying asset continues and reaches our strike, up to approximately 147,500, then the profit can be 2,500 conventional units, with 90 invested. The second important parameter is theta. This is the time value of the option. Options have an expiration date. It can be, for example, a week, 2 weeks, a month, 2 months, and so on. And the longer the time to expiration, the more theta. If there are a couple of days left before expiration, then theta will be practically at 0. Schematically, this can be depicted as follows. Theta decays throughout the life of the option, and it begins to disintegrate the fastest a week before expiration. This happens because, for example, when there is still 1 or 2 months left before expiration, the market understands perfectly well that anything can happen. The price can go in any direction. And that's why theta decays most slowly. But when there is 1 week or several days left before the expiration of the option, the market understands perfectly well that the probability of a price hike in one direction or another is significantly reduced, and therefore theta begins to burn out much faster than at the beginning of the option's life. Options that expire in a few months will cost significantly more than options that expire in a few days. As a rule, options with a distant expiration date are used in directional trend strategies, where you plan to purchase an option and hold a position for a long time while the trend growth continues. In this case, you will earn on the growing delta, but lose on the decaying theta. If you plan to trade short-term for 2 or 3 days, when there are several days left before expiration, theta will have virtually no effect on your position. However, here you need to understand that you will have to act more aggressively. And there can be no question of any trend movement here. As a rule, you will have to use breakthrough strategies, but when you see that the underlying asset rests on some level of resistance and think that a breakdown of this level will take place, then it is here that you need to buy a call option with the hope that a fairly sharp one will take place, an impulse breakdown, and your profit will not be 10 or 15, and maybe 100, 200, or even 1,000 points. For the buyer of theta options, there will be negative; for the options seller, theta will be positive. The next parameter is gamma. There is nothing complicated here. Gamma is the rate of change of delta. For example, out of the money options with a far strike price relative to the current price of the underlying asset, gamma will be minimal. We already know that if there is some underlying asset and you bought a call option with a distant strike, then the delta of such an option will initially change very slowly. And as the price of the underlying asset moves towards the strike of this option, the delta will increase more and more. The last parameter is vega. Vega is volatility. But don't confuse it with the classic volatility on the chart. Vega displays the degree of uncertainty. Vega directly affects the price of options. For example, take the situation that occurred at the end of February 2020 on SPY. SPY then fell very much. At that time, options were more expensive, Vega was at extreme values, and as a result, VIX was growing. VIX is the volatility index for the SPY index. And looking at the growing VIX, you can conclude that put options are growing in price. Put options usually increase in price in two cases. Either the market begins to expect a further downtrend, or players prefer to hedge their risks due to uncertainty. Thanks for watching. In the next lesson, I will show you some strategies that will help you make money. Good luck!